The topic of today's discussion is the bank's balance sheet. We have discussed before the Fed's balance sheet. Now we are going into individual banks to try to understand what their balance sheet looks like. So in a balance sheet, there's two sides we all know, and one is the assets, which is the uses of funds, and the other is the liabilities, which is the sources of funds. And mind you, balance sheet needs to balance all the time, which essentially means your assets needs to be equal to your liabilities. So first we'll start with the assets, which is how funds being used by the banks and how they are using the money they receive. So first let's start with the assets. And the assets, the first most important thing is the reserve and cash items. And you can see the reserves and cash items are basically the money that banks has based on the deposits that's being done and the reserves they have kept in their vaults. And as of 2017, this number is around 14%. That is 2017 numbers. The next item in this is the securities. Now there are two kinds of securities that banks typically hold in this country. These are US government and agency securities. These are basically securities issued by the US federal government and the agencies like the Social Security and also Fannie Mae and Freddie Mac, the mortgage companies run by the United States government. That include about 15% of their assets. Then banks also like to hold a lot of state and local government and other securities as well, which is about 6%. This includes munis or municipal bonds. Now these bonds are very helpful because they are tax exempted, especially the local government bonds. Next items are the loans. Now mind you, loans are an asset for a bank because every time banks lends out money, they are getting a return on it based on the interest being paid. Now, most important form of loans for a bank are commercial and industrial loans and real estate loans. Now, commercial and industrial loans account for about 13% of the bank loans, and the real estate, which is perhaps the most important one, around 26%. That followed by consumer loans. That's basically loans given to you to buy your new television, new car, and all those stuff. And then the interbank loans. These are your federal funds market. Mind you, banks also lend to each other. So interbank is your federal funds market where they, and it's about 1%. And there are other kind of loans that banks often lend out. In addition, it has other assets. What are those other assets? These are physical capital that banks are holding. For example, they might own a building, they might own other kind of assets. This accounts for about 8%. And if you add all these things up, total comes out to be 100%. So these are the asset side of a bank's balance sheet. Now we'll move to the liability side. The most important liability of a bank is the checkable deposits. That's the money that you and I put in a bank and carry out day-to-day transaction in our checking account. Any money that's lying with the bank is a liability for a bank because that's the money that owe to us, and that account for 11% of the total deposits right now. There are also non-transaction deposits. This includes savings deposit, which is a very important component, which is about 49% of the bank deposits. Then there are small and large denomination time deposit. These are nothing but your CDs. That's certificate of deposits. Then there are borrowings by the bank. Banks also borrow from other banks or from the Fed. That includes about 70%, and obviously that's a liability for a bank. Then finally, there's a bank capital. Bank capital is a residual thing. That means it is basically shareholders portion. That's the money that's raised by bank by selling stocks in the bank. If you just add up everything, it should come to 100%. Now here's the most important thing, and I'm going to write an equation where total assets equal to total liabilities plus bank capital. Now, bank capital is often seen as a residual item. That means anything that doesn't balance the asset and liability side of the bank is supposed to come from the bank capital. That's the money that's been collected by the bank by selling stocks. That's the first time they issue IPOs, where they basically collect the money. Okay, so bank capital is the residual portion which balances the assets and the liability side. Again, the most important takeaway point from this lecture is this: a bank balance sheet needs to balance a most important asset for a bank are obviously the loans and also the reserve and cash items. And the most important liability for the bank are all the deposits in form of savings deposits, checkable deposits, CDs, and also borrowing. And the balancing factor in all this is the bank capital, which is shareholder portion.